What's up, everyone? Erik here from Outlier Trading, and today we're going to talk about trading presidential elections. Now, quick note up front. There is no political bias in this whatsoever. That's the cool part about markets, is that it's really less about red or blue and we care about green. So I'm going to be approaching this completely focused on the opportunity provided through presidential elections, different ways to think about the effects, what some of the tendencies are, and some of the different securities that might make sense in different scenarios based on what your analysis of the current and upcoming election might look like. So before we get too far into this, as you know, we have to start with a beautiful disclaimer that is letting you know that I am not a financial advisor. I am not affiliated with Barchart. I'm here just to share information and to help people tap into my experience from trading and hopefully give you all some ideas to consider. So let's get right to it. What are some of the broad documented effects of presidential elections? And I actually think Paul Tudor Jones, who recently did a CNBC interview, they phrased it like literally perfectly. And he said that it's like the macro Super Bowl that's coming up. There's a lot of potential, pretty significant impacts that we're going to see. And the way to think about the election writ large is that it is essentially a binary event that is going to impact both economic policy, which then trickles down to the markets, and even a little bit of vice versa action. So what are some of the broad tendencies? Well, we have the typical expansion in implied volatility leading into the election, and then starting to try to price in the effects of different policies by the different presidential candidates. For example of the implied volatility, let's take a look at SPX on Barchart, and you can take a look at the implied volatility for two different periods. Here, we have a 17.3% implied volatility in SPX in the 7 November expiration. And then if we take a look at the 5 November expiration, it's only 12.72%. So you can see that there's a pretty massive expansion of volatility leading into. So what's going on here? Well, if we take a look at the 5th of November when election starts and people can vote, we won't know the answer on the 5th. Now we can start seeing some of the results. And if we take a look actually on the 6th, implied volatility jumps to 16.24%. So the reason why we see volatility higher on the 7th is because a few days pass before we get certified results of the election, but you can see leading into the period where we actually get results, volatility does in fact expand. Now, the other thing I wanted to talk about is this policy inclusion. Now, this is something that you're going to have to do some research on your own. And there's a couple places I found that are pretty cool, but you can just go into Google and type in presidential candidate policies. And there's this cool comparison. This is by American Century Investments. And they have a download essentially of different policy focuses for both Harris and Trump to come up with what these things might impact, which we'll get into a moment, what kind of securities you might be thinking about. And then if you go to BBC, it has kind of a similar thing that talks about what their focuses are on key topics like inflation, taxes, immigration, foreign policy. So there's stuff in here that doesn't necessarily directly impact markets, but stuff specifically like trade, climate, healthcare, those kinds of things absolutely do. So we can take a peek at some of these different sectors that are likely to be impacted for different reasons based on taxation policy. So we can have tariffs. One of these examples is Trump is talking about more strict tariffs on China, and that might impact some of the interpersonal relationships, or I guess inter-country relationships between China, different Chinese companies, different companies that rely on Chinese components. Those kinds of details are important here. So you can see another example in terms of cryptocurrency that there is a slight difference in the policy between both of them. Harris has been a little less specific about her policy, but she's talking about being more crypto friendly, and Trump is known to be pretty pro crypto. So these different kinds of policies that each candidate has will trickle down into different securities. You're going to see it represented in financials based on things like regulation, defense spending, so on and so forth. And it's up to you to see what you best think is likely to happen based on who may or may not win. And if you're curious how to even come up with an idea of who is likely to win, well, you can look at things like event-driven markets like Polymarket or Kalshi. Both of them have pretty well-known event-driven markets that you can see what the current probabilities are. You can also see in lead-in positioning coming into the markets, coming into the election by markets. So there's a couple different things that you can take a look at, and whatever you personally believe as well. So there's another couple things that I want to highlight here at a high level. So you can see that we know for a fact that there are effects of markets on politics, which is actually pretty cool. This is a study that you can check out that taps into some of the back and forth relationship between presidential policy and market performance. And then on the right-hand side over here, you can kind of take a look at the way that we see under different presidential candidates or administrations, I guess in this case, what the performance of the markets have been. Now, it's important to remember, markets tend to exhibit positive drift. So because there's positive drift, we don't necessarily see these, massive negative years, and there's always multivariate, but you can run an analysis and see what the average looks like for these different periods in time to see if there's, any specific lean that you might have. And this is looking back from 1990 to 2023. One of the things to note is something like the variance risk premiums associated with elections has actually become more pronounced in the last 2 decades or so. So it's important to note that, because if you look at an analysis going back to like the 60s or the 30s, you'll see the risk premium is actually a little bit smaller than it has been as of late. So if we take a quick look on Barchart, you'll see that there's a way for us to analyze sector performance. And you can see some pretty interesting trends here, where things that typically have been really rallying hard, like information technology, it's still obviously leading, especially if we look back over the past year. But if we look at things more so like year to date, there are things that have started showing a lot of strength, one of which being financials. So that's obviously front running a little bit what might be expected from the election. They've also had a really good earnings cycle. So you can use tools like this to come up with some sort of idea related to which sectors you may or may not think may or may not outperform based on your expected outcome. Now, another really interesting inclusion here that is kind of, it's pretty unique, is that there's a stock, DJT, that's essentially tied to Donald Trump. This is his media corporation. But the interesting thing is this is clearly being proxied as a expectation of the outcome of the election. So you can see that there's a pretty massive rise here. People betting on the outcome of the election one way or the other. And the really interesting thing here is you can see that in terms of earnings per share, annual income, all of these things are still negative. There's not any sort of massive internal change in terms of the financial performance of the stock. So this is essentially being used as a proxy. So this is relatively unique because presidential candidates don't typically have a stock that's associated with them for people to speculate on. But this is another way that you can think about the election. And again, depending on who you think may or may not win, you could still trade something like DJT. If you think Trump might win, you could trade it to the upside. If you think Harris might win, you could trade this to the downside. You can also use those prediction markets that I talked about before. You can use the individual sector performance. There's a lot of interesting ways to get involved, but a really big important point here is to make sure that you're taking a little time to understand the policies, because this will be really important in terms of seeing what sectors will behave and how they might behave, because different sectors are likely to be impacted to different degrees. So, as always, if you have any questions, let us know in the comments. Be an outlier. We'll see y'all later.